Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome, welcome, welcome. My name is Robert Kuhn. This is Destination Retirement. Thank you for joining us this weekend. I am the host of this radio show. I'm also the president and founder of Kuhn Capital Partners. We are an independent registered investment advisory firm. We are a fiduciary. If this is your first time listening to us, thank you. If you're a repeat listener, thanks again for coming back to us. We see the podcast numbers are significantly up and to the right. So I want to thank everybody for downloading the podcast. It's great to see. We ask that if you find value in the podcast, that you send the show on to someone who needs to hear it. Really, our main focus is education. We think individuals who understand things and are educated on what your investments are, what they are not, maybe some risks that your current portfolio is not addressing. We find that those individuals really have just benefited from talking with us, and I think clarity allows individuals to make good decisions. So our job is education. 630-492-1912, 630-492-1912 if you'd like to get in touch with us. Everything that we do is embracing uncertainty. I think we incorporate uncertainty in asset allocation construction, which we believe helps investors overcome the shortcomings of traditional portfolio methods. There are many, and those investors who just have mutual funds, certainly if you have over $100,000 and you have mutual funds, we want to have a conversation. Average mutual fund loses 2% to taxes in performance. So that's a big deal. Mutual funds lack customization. They lack transparency. They lack tax efficiency. So if you have over $100,000 and you're currently in mutual funds, let's have a conversation about our growth strategies. Our 5 growth strategies all rank, the ones that we utilize, all rank in the top 5% of all asset managers for their category. 2 are in the top 1, and 1 is in the top 4, and then 2 are in the top 5. So individual securities are transparent, they're customizable, and most importantly, they're tax efficient. So we want to make sure that when you own an indexed fund, especially, you own the good and the bad, and that's a challenge. So especially in this market. So a lot to get to this week. I want to talk about the market. I want to just have some really interesting random thoughts that I think you're going to find of value this week. So if you want to have a conversation again, just simply give us a call, 630-492-1912. Paige will set a time for us to have a conversation this week. A lot of people who are reaching out, here is why. They've done really well. Certainly the markets have done really well, and you can't confuse the markets doing really well with a strategy that can handle turbulent times, but unfortunately a lot of people did. So from 2009 to 2021, other than a couple blips in 18 and 2020, most people have done very, very well. And so they thought their portfolio could handle all markets. And then 2022 was a shock to them. Not only were equities down, fixed income was down as well. And so a lot of individuals that we're talking with currently are tired that they didn't have a proactive strategy in place. They didn't have volatility management and volatility strategies inside of their portfolio that could mitigate equity losses, that could remove fixed income losses. I was looking and I got an email from, a big company, everybody knows them, and their fixed income, not just theirs because they're an index fund shop, so no fault of their own, because their job is to just make sure that they are creating strategies that simply track an index. And so they believe that no matter how much you lose, that you just have to stay the course. No matter how bad the markets get, no matter how bad geopolitically it gets, no matter, what is going on with inflation, with interest rate hikes, with decimation in the bond market, that their answer is, well, you just have to sit and take it and sit and wait, and ultimately it'll come back. And that's just not good enough, especially in an environment like we're going into, which I think is going to be low growth to no growth if you have the wrong strategy in place. If you have the right strategy in place, you have some volatility planning in place, then we certainly can make some money. But a lot of individuals that I'm talking with are tired of the fact that their advisors are just simply not proactive in any way. They collect their fee, and then they simply try to justify why it's okay ultimately to lose money. So back to this company that everyone knows. A lot of their ETFs on the fixed income side last year were down anywhere from 14 to 35%. So people candidly were shocked when their equities were down 15 to 23, 24%, and their safe money was down substantially. Here's the email that I got as an advisor. Okay, so it's not going to the individual, it's going to the advisor. There's no getting around it. Last year was a tough year for the bond market, which is why we are excited to share the news that we see great opportunity for active fixed income management to shine in 2023. How does that make you feel after you lose 15 to 30% of your safe money? How would that make you feel when you call an 800 number and talk to 3 or 4 or 5 different people who have generally very limited knowledge, very early in career, which isn't bad, but, they generally haven't seen, like we have, a late 90s, a 2000 to 2002, 2008, and then certainly, here recently. But how is that supposed to make you feel? Sit and wait. Don't do anything. It's okay to lose 30% of your safe money, 20% of your safe money. It would be frustrating, and I would imagine that it's frustrating for you. So those are the individuals that are reaching out, those that want to learn about more proactive strategies. Again, as you know, we have a philosophy of protected growth or protected income, which is really the topic of the first segment. Is the greatest risk to retirement is longevity. We'll get to that here in a minute, but our philosophy of protected growth, protected income, growth, but not growth in mutual funds or ETFs. We want to be very targeted. We want to use industry leading strategies via Morningstar. So this isn't, self-leading. It's the strategies we have access to and we employ for many of our clients. They report into Morningstar, and when you can have 5 strategies that offer different buckets, cover different buckets, and 2 are in the top 1%, and then the other 3 are in the top 5% going back to inception, that's strong. So we believe in active management on our growth side, and then our opportunistic growth. If you have over $2 million, you have access to opportunistic growth that, you may not be aware that you have access to. So we want to talk about that, especially if we're in a choppy market. So 630-492-1912, 630-492-1912. And Paige can set a time up for us to talk this week. Protected strategies currently, I want to give you the rates. They're still relatively high. For the protected growth bucket for capital appreciation for growth, it's still 15% of the S&P 500. It's just one of those periods of time that, interest rates, volatility, it's kind of a perfect storm. So you can get principal protection, 100% principal protection, meaning your worst year is 0, no matter how much the S&P 500 drops. Any gain you get in a year, that gain is locked in. So that's very nice. You don't have to play that catch-up game. And then currently, the rate is the first 15% of the S&P 500 is yours. Nothing more than that. But for safe money, most people will identify with the fact that 15% is pretty good. So that's the protected bucket. I want to make sure that we give those rates each segment because a lot of people are looking for fixed income repair strategies or strategies that, aren't subject to interest rates or inflation and what may happen there. Longevity is a great thing. I think longevity is fantastic, right? We want to live longer. The challenge that is happening is one of the greatest risks to a successful retirement is longevity. Or wealthier people are most likely to outlive the averages. That's just kind of what statistics say. And, if you ask clients to name the most important risk in planning for retirement, generally they're going to come back with something related to the market, something related to the economy. It may be stock market risk. It may be inflation. It may be geopolitical. It may be the cost of health care. And really, the correct answer is none of the above. Research tells us that the biggest risk to a retirement plan is longevity, even for those investors who have $3, $5, $7 million. Okay, this is not just for those that have a couple million or a couple 100,000. As you know, as a firm, we are very conscious about making sure that we help everybody. We think wealth is individualized, and we take just as much pride and care with that $100,000 client as we do with those clients who are worth, $20, $30, $40 million. So just wanted to make sure that we always let you know that we're here to help regardless of how much money you do have. So research again has told us that retirement planning, longevity is the greatest risk. The danger of exhausting resources clearly before the end of your life is a challenge, and it is the least understood by people planning for retirement. I can't tell you how much when we, one of our plans and one of our reports is our income maximization, our tax maximization. I mean, it's just our tax reduction strategies. I mean, there's so many reports that you can run, but longevity risk is rising. And when I talk with somebody, they don't have a plan as far as their distribution side. Easy to make money, right? Well, if you have the right strategies, I mean, over 20 to 30 years, it's easy to make money. But I think over the next handful of years, it may be a challenge. It might be 3 to 5 to 7 that we see, ups and downs, but we really don't go very far. But I'm just shocked that people aren't leveraging insurance companies or banks to allocate some capital to strategies that can give you not only guaranteed income at a rate that is generally not replicatable, not even by somebody with $100 million, and has the opportunity to increase each and every year. And it's going to last for as long as you live or as long as you and your significant other lives. So, longevity risk is rising. Lifespans are increasing. And the income products and strategies available to hedge risk against that, they're very inadequate. And fewer retirees have guaranteed income protection of a defined pension plan. I mean, I think that is pretty well known. And mapping out safe withdrawal rates from portfolios presents, let's just be honest, thorny problems. People are still looking at, well, is 4% enough? Well, is 3% enough? Well, is 2% enough? Well, is 6% enough? And the reality is that so much of your success in retirement is where are we at in the market. So I want to make sure that I spend a lot of time this show talking about longevity and why I think it's the biggest threat to a successful retirement. And there's ways to hedge against it. Again, we hedge against risk in every area of our life. If we can hedge against longevity risk and income risk, and the income that we need, that's just money that we can free up to invest for growth or opportunistic growth or private equity strategies that are not dependent upon the market to do well. They're going to do well independent of whatever's going on in the market. So when we get back, we're going to, again, dive a little deeper into longevity and really talk and kind of break it down so it's easily understood. Any questions that you have, if you want to listen to all of our past shows, go to kuhncp.com, and you can find the radio show and the podcast there. If you want to set a meeting or a call for this week or, whenever is convenient for you, give Paige a call today. 630-492-1912, 630-492-1912. More after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. I'm also the host of this radio show, Destination Retirement. Thank you for joining us. If this is your first time, welcome. If you've listened to the show in the past, welcome back. Either way, if you want to hear our past shows or if you want to listen to this show in its entirety, you can go to the website. We do podcast every episode, KUHNCP.com, KUHNCP.com. Click on the radio tab and you can get all of the past shows there. And we ask that if you find interest of any of them, just send them out to friends, family, anybody who needs to hear the message. We're certainly here to help. As you know, we often talk about we believe in facts over feelings. We believe in a data-driven process. It's the best way to manage money. We want uncertainty strategies in place. We embrace uncertainty. We incorporate uncertainty planning in our asset allocation and portfolio construction, which I believe over time helps overcome the shortcomings of traditional portfolio methods. As you know, my job is to identify what your biggest risks are and actively manage and hedge against those risks. Our goal is to simply pursue better outcomes for clients. That's it. And if anything that we talk about piques interest, or you want to talk about your situation, you want a second opinion, you have any kind of finance related question, it's really simple. Give Paige a call. Paige will set a time up for us to chat this week. 630-492-1912, 630-492-1912. So a couple things on the structured note side. So for those that are looking for cash alternatives or are looking for a home for 1 to 2 years and you don't want to go into fixed income because of interest rates and the uncertainty there, as you know, if you've talked with us or if you've listened to the show, we utilize banknotes. Banknotes they're not new. They're just not heavily marketed. But it's couple $1 trillion market space. So it's very big. All the big banks, JP Morgan, Chase, JP Morgan, Bank of America, Morgan Stanley, UBS. All the big banks, offer them. There's some pretty attractive couple-year note strategies paying around 8% with 20% downside protection. So if you have some short-term money that you're looking for, let's have that conversation. If 8% would be appealing to you with 20% downside protection before you lose money, we've seen a lot of money flowing to those strategies. The guaranteed rates currently, as I mentioned in the first segment, we're going to mention them every week because they're just so strong currently. It's one of those, perfect storms with interest rates rising and volatility doing what it's done. If you've lost a lot of money last year in fixed income, let us help you recover that money. We believe much quicker than leaving it where it's at. There's some fixed income alternatives that we use that are principal protected, so meaning your worst year is zero. Any gain you get, it's locked in for the life of the investment, so you don't have to play that catch-up game. And that's also currently capped out at the first 15% of the S&P 500. That's what it is as of today. So those could change, certainly, but that's certainly a conversation that many people are starting to have because anytime you can get possibly equity-like returns with safe money, certainly something that we want to, potentially dive a little bit deeper in. So we were talking about what I consider the one of the greatest threats to a successful retirement is longevity. It just is. We see it, and when you look at Social Security certainly provides a measure of protection, but it replaces obviously a smaller percentage of pre-retirement income for, wealthier households. We have clients that, don't need their Social Security in any way. And we have clients that live and budget down to the, the penny what their Social Security is. So everybody's, in a different spot. And I think, and one of the things I'm most proud about is the same intellectual capital that works with those investors that have 30 or 40 or $50 million net worths. We provide that to those that have $100,000, $150,000, $80,000. And we're very, very proud about that. And we're going to continue to do that. So, when you look at, Social Security, who knows what's going to happen? And we look at, 1 out of 3 men and half of women who are in their mid-50s now will live to the age of 90 or above. And that's just what the actuarial tables say. And the wealthier better be ready to make sure that, you have the money to provide, the standard of living in a rising interest rate environment that you've become accustomed to. Because when I look at kind of longevity and having that longevity conversation with clients, most advisors don't explore longevity with clients in depth. I mean, we just look at, kind of actuarial tables. And let's be honest, it's an uncomfortable conversation. It's an uncomfortable topic. And, when you talk about setting up trust so the next generation is protected, or, how long, your money will last. I mean, it's just sometimes, not a fun topic to think about your mortality, but it is our job. And first and foremost, our job is to make sure that the money that you have, whether it's 100,000 or whether it's 5 million, is going to be there to provide the lifestyle that you've envisioned, that you've worked hard for. Ultimately, that's our job. So, we don't want to make just assumptions without having a more in-depth conversations about probabilities. And when you look at probabilities, unfortunately, a lot of people use Monte Carlo. It's an income simulation of the market versus randomly generated returns, basing it upon the resources that you have. And what a lot of people, and it comes up with a number, but the challenge is sometimes the outliers happen. And my question to you is, would you rather insure against those outcomes, or would you just rather hope that they don't happen to you? And when it comes to the market, man, what you don't think is going to happen happens a whole lot more than it does than you would like to think. And if you look at 87, I've heard the statistic being 1 in a trillion that the crash of 87 would happen. You look at what happened in 2000, 2001, 2002. You look at 2008. You look at 2018. You look at 2020 with COVID. You look at 2022 with, fixed income and equities being down simultaneously for the first time ever. The outliers happen. And the more money you have, the more creative you can get. Because what we find is that 37% of adults have a strong understanding of longevity. And, it's somewhat a little higher when you're looking at boomers. It's about 44%. But, it's just a challenge. And you have to make sure that when you're talking about longevity and longevity planning, it ultimately gets into withdrawal rates. And the question of longevity, which is baked into any client discussion, it should be, well, at least we know with our situation, it's baked into that conversation with everybody. But it is, what about safe withdrawal rates? Since the goal is to stretch a portfolio in the assets inside of that portfolio through retirement, there's significant complexities that swirl around the topics, with endless debates about from retirement research about the rules of thumb on drawdown rates. And we've heard it all over the course. It's all over the map. And my thought process is, when you're looking at sustainable drawdown rates, it can be tough to understand from, a client standpoint. If you look at Morningstar's latest research on safe withdrawal rates, which pinpoints 3.8% as a safe starting rate for retirees seeking a fixed real withdrawal over 30 years. What that does is that assumes a 90% likelihood of not running out of money. A balanced portfolio, can you live on 3.8? And you have to look at, what does that mean? 3.8%, what happens? We talk about the outliers. Well, 10% of the time you ran out of money, right? And if you have a portfolio of a few $1,000,000 or 4 or 5 or 6, don't think that this doesn't pertain to you as well. Because what you could do is you could be creative about hedging and utilizing the balance sheets of financial institutions to provide income that you just can't replicate. And that could then free up your other assets, more for growth. So 10% of the time it didn't happen. So what happens during that 10% of the time? You just have to go back to work. You just run out of money. I mean, retirement is supposed to be the fun years, the golden years. We know all of that, right? It's my thought process of 23, 24 years in the business, when you can look at somebody's portfolio and you can dissect it in three simple ways to understand it. We've got our protected income or growth. We've got our growth, and then we have our opportunistic growth. When you have that protected income bucket covered, meaning you look at pensions, you look at other guaranteed sources of income, which is generally Social Security. And then whatever the shortfall is there, we'll let you utilize a strategy that will give me income for life at a rate that you just can't replicate. What does that allocation look like? Well, it may be 20%. It may be 40%, maybe 60%, maybe 15% of your portfolio. That's totally individualized. But it's my thought process that if you look at behavioral finance, and if you just have a brain and have some emotion, if you know your income needs are met, whether it's $50,000, $100,000, $300,000, $500,000, whatever that number is, if you know those income needs are met, no matter what happens in this crazy economy, worst case, it's going to free up mentally, you're not going to, you're going to free up mental capital because you're not worrying about it. You're not going to be as stressed about it. And then you could look at growth and opportunistic growth in a totally different way. And that is what we have found to be the best, really the best use of somebody's money, is just making sure that through our planning process, which everybody has a financial plan, everybody has a Social Security maximization plan. You paid into it, you might as well maximize it. Everybody has an income maximization plan, a tax reduction plan, and then an estate plan. Well, that's when we start to look at, okay, well, I know my income needs are met, so maybe I can be more opportunistic with my growth strategies. Maybe we can seek higher rates of return, because if we go through some volatile periods, I know that I'm not pulling money out at the wrong time to have to, give me my paycheck. Because again, 30 years in retirement, think about that. How many bear markets are we going to see? The market can outlast you. It doesn't matter how much money you have. It could outlast you. And the market's going down and your income needs are still there. You look at what's going to be needed for healthcare. You look at inflation. You look at, just purchasing power. There's a lot of credence that is being finally given to the fact that let's insure my income. Let's have a strategy that it's still my money. I never lose access to the principal, but an insurance company or a bank strategy is going to go on the hook for some rate of return, for some compensation as far as longevity insurance, as far as income goes. So they're very basic products, very simple strategies, but I've found them to be very, very useful, because what it does is it frees up the real growth bucket. And then we can go after some real growth. And that's ultimately, fun. So with that being said, give Paige a call, 630-492-1912, 630-492-1912. She'll set a time for us to talk this week. More after the break.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want defined outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Okay, welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I am the host of this radio show. Hopefully you find value in the show. I think you do. I look at the podcast numbers because, as you know, we do podcast every episode that we do here on WLS. You can listen to past shows going back several years, hear what I was saying when times were good, when times were bad. I think that's maximum transparency. I think, we're pretty consistent in our beliefs, and I think you'll find value if you listen to some of the older shows. You can do that by going to kuhncp.com, kuhncp.com, and listen to the click on the radio tab, and make sure that you send a show on to somebody who may need an interest or who needs to hear our message. Again, we embrace uncertainty. We incorporate uncertainty planning. What does that mean? That means we incorporate uncertainty in asset allocation strategies, in portfolio construction, which we believe helps overcome the shortcomings of traditional portfolio methods. Ask yourself what happened last year. Did your equities go down? Check. Did your fixed income go down substantially? A lot of times, check. What changes or were offered from your financial advisor, or if you're doing it on your own? If you really, more importantly, what proactive strategies were put in place? To me, the train was so visible for so many miles down the road coming that the Fed was going to raise rates. And I'm just still shocked how many people lost 15 to 30% of their safe money. And I put that squarely on the shoulders of the advisor. And if you're managing the money on your own, unfortunately, the buck stops with you. But it's, we're here to help, and that's our job. So we always want to make sure we pursue better outcomes for clients. And that's something we're very passionate about. I think you have to structure portfolios with forward-looking views, where we're going, not where we've been. If you have over $100,000 and you're in mutual funds, hopefully you know that mutual funds are not transparent. They're not customizable. They're not generally tax efficient. On average, if you own a mutual fund, you lose 2% a year in performance due to taxes. Many people are probably surprised that they lost money last year in their funds and still got hit with a 1099 capital gain. We believe in individual equities. We believe in active management. We believe in forward-looking active management. Most importantly, strategies that we utilize for our clients, they all rank currently in the top 5% of all like managers. So that's going back to inception, some all the way back to 1995. So we definitely have some very award-winning strategies that, they've beaten the index. I'm tired of hearing that you can't beat the index. 26% of advisors or of managers still beat the index. And then, yes, the longer you go, the less, beat the index. But that doesn't mean that they're not out there. Managers are out there that beat the index. Generally, you just don't have access to them. So, we do. And a relationship with us, oftentimes will allow you access to those types of strategies. So give Paige a call, 630-492-1912, 630-492-1912. Set a time for us to talk this week. Generally, we have a good introduction call. If we feel like we can help you and you're open to our help, because we can't help those that don't want help. That's not our job. My job isn't to try to talk you into needing help. My job is to help those that want help. And there's plenty of people, certainly throughout the United States, absolutely here in the Chicago area, which is where we're headquartered. But, we do have clients in other parts of the country and, a lot down south. And so, we're here to help those that want help. So let's talk about a couple reasons why investors should be more cautious than confident. And just because we talk about the what ifs, right, doesn't mean that you can't make money. That doesn't mean that you can't, see positive returns in challenging markets. My concern is that we're going to go up, we're going to go down, we're going to go up, we're going to go down. And those investors that have a buy and hold strategy, they're going to go crazy because they may not see the growth long term. They're going to see a lot of growth. They're going to give it back. They're going to see a lot of growth. They're going to give it back. That's my challenge. And my challenge to you is, could your portfolio handle that type of a market? So a couple reasons that I think you need to be concerned. Optimistic investors certainly are sending the U.S. stock markets higher. It's the market has, up until really the last week, it was a really great January. Most people still haven't recouped their equity losses from last year, and certainly not their fixed income losses. They probably, did in the beginning part of the year, but they're now losing money again in many fixed income strategies. And you just have to hear me. You need to look at other strategies when it comes to that. These principal protection strategies, 100% principal protected, gains are locked in every year if you receive them. And the current rate is 15% of the S&P, meaning you get the first 15% currently. That could change, but currently it's 15%. Show me a better fixed income strategy. I just don't know if one exists. So a couple things you have to worry about. We've all heard the old saying, don't fight the Fed. A couple of the sayings used to be the markets could stay irrational longer than many people can stay solvent. That was one that we kind of used in the early 90s when you had clients asking you, what did you do wrong? You were only up 25%. And we kind of got back to that feeling from 2009 to 2021. I mean, depending upon asset class, there's a good chance that you average 13 to 16% a year. So you really compounded your growth. Now, the challenge is, are you going to keep it? Are you going to keep it and not give it back? And maybe more importantly, in a flat to sideways market, are you going to still compound your money? Because that's what separates the good advisors, the good strategies from the rest. Anybody can make money from 2009 to 21. Anyone. I mean, it's simple. The good advisors are going to still compound your money when it's not easy. And that's what we put ourselves in that category of wanting to do. So, don't fight the Fed. I think when you look at cautions against investing in ways that might run counter to whatever the U.S. central bank policy is, they seem heck bent on keeping rates higher. Inflation is certainly kind of coming down. I mean, it's hard to dispute it's certainly coming down, but certainly at a much slower pace. There still are pockets of very, very high inflation. And I think we just have to listen to what the Fed says and not try to parse his words and read his mind. I mean, they're very data driven and seems like they're going to keep raising rates. And yes, they may be towards the tail end of raising rates, maybe not, but it seems like they are. But it seems like they're going to stay high for much, much, much longer than anybody expected. And that could be very challenging for equity markets. And for those investors in their 50s and your 60s and your 70s, it's a recipe for, uncomfortable conversations, uncomfortable years, uncomfortable volatility. And so I want to make sure that you just know this going in, because I think if we do our job of explaining it and you choose to ignore it, or you're okay with that volatility, it's your money. I mean, who in the heck am I to say what you should or shouldn't do with the money that you've worked so hard to earn? I just hope that, you're just not sitting with a strategy of just sit and buy and wait, buy and hold, buy and hold, buy and hold, look at 100 years worth of data and the markets will do X. I mean, that's about as irrelevant as yesterday's newspaper, because it does not mean anything to you, because we've had significant periods of weakness and we've had prolonged periods of underperformance. You bought Microsoft in 2000. It took you 16 years to get back to even. What happens if your portfolio doesn't grow over the next 1 to 3 to 5 years? You grow at some periods, but then you give it back. Then you grow again. Then you give it back. Then you grow again. Then you give it back. And then you reach out to an advisor and you say, well, sit and wait. Well, that's nonsense. So we have to have a strategy in place that can handle volatility, that can do well, at least a bucket of your money in all markets, because investors today, they seem emboldened to wage the fight against the Fed. The Federal Reserve has offered explicit guidelines that continued monetary tightening may be needed to subdue inflation. They're being as direct as they can. But yet investors, they simply seem to ignore what and how much the tightening and the longevity of these interest rate hikes in not being cut, how that could further weigh on the economy and corporate profits. So you have to be very concerned. Instead, markets, they've ripped and roared so much so far this year, and they're rallying on apparent conviction that inflation will quickly fall to the Fed's target of 2%, and the central banks will soon start to cutting rates. I mean, think about that. That's the rationale of looking at future earnings and the multiple that you want to pay for those. So the rebound that we've experienced, it's sent valuations to pretty high levels again. The S&P 500 is priced at, give or take 18 and a half times forward earnings. And that's still very, very expensive, and especially expensive when you have kind of all of these underlying risks. And we didn't even talk about this craziness that we're shooting down this, we're shooting down that. And, is China going to invade Taiwan? And you look at the geopolitical risks that we have. There's just so many things that could take a retirement or a plan off course. And we just want to make sure that we're planning for those. And a simple buy and hold or buy and forget strategy, a balanced strategy, whatever the heck that is just not going to cut it. So the question is the confidence warranted of this recent run-up? Is inflation truly tamed? And will the U.S. economy come out of this tightening cycle, with just a scratch? We're starting to hear soft landing, hard landing, medium hard landing, and no landing. It's about as useless as you taking a risk tolerance questionnaire and it's saying you're a moderate aggressive investor. I mean, what's that? What's a moderate aggressive investor? I mean, here's the reality of it. Regardless of your age, when there's opportunity, you want to make money. You want to make as much as you can. When there's risk, why should you lose money because you don't need this money for 20 or 30 years? And if you do simple math, the more you lose, the more you have to make just to get back to even. So even if you're an aggressive investor, that doesn't mean that you should be ultra conservative at times. And, those are the things that, we believe a couple things, and we'll get into kind of our beliefs of the market in the top of the next segment and what we think, but it's a challenge. And if I know anything, I know that your portfolio needs maximum flexibility. You have to have some protected growth, some protected income. You have to have some growth money, and you have to have some opportunistic growth money. And if you have mutual funds and you have over $100,000, my question to you is why? Lack of transparency, lack of customization, lack of certainly not tax efficient, and there's a better way. So we want to have that conversation this week with you. 630-492-1912, 630-492-1912. When we come back, we're going to talk about a little bit more of what we believe with some of the uncertainty and things that are making us a little bit nervous. So 630-492-1912. More after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert, 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Okay, welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I'm the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are a fiduciary. Retirement strategies, they really, if you boil them down to a simplest form, they come down to two words: taxes and savings. But they're much more than just two words that you need to consider. You need to be thorough. You need to be nimble. You need to have strategies that can do well if the markets aren't doing well. And as you know, we've talked a lot about protection strategies, kind of our philosophy as kind of a bucket approach. We want some protected growth or income. Those rates are currently 15% on the S&P. So your principal protected, so you can't lose money. Your gain is locked in each year. And the current growth is currently 15%. That can and does change, but currently it's 15%. When you look at the growth side, we're big believers in active management. Our strategies that we bring to clients, our 5 models that we utilize currently, all rank in the top 5% of asset managers, 2 in the top 1%, and the other 3 in the top 5. Individual equities, it's customizable, it's transparent, and it's incredibly tax efficient. Mutual funds for over $100,000, they just simply don't provide that, in our opinion. And if you own index funds and that's it, like we see so many people do, you're owning the good and the bad. And we would prefer that you just try to own most of the good and do away with the bad. So give Paige a call this week. She'll set a time for us to talk, 630-492-1912, 630-492-1912, or visit the website, kuhncp.com, kuhncp.com. Again, if you're hoping that your money's going to come back, I think generally many times it ultimately is hopeless. So we want to make sure that our planning is focused on helping clients forecast how their portfolios are going to look in retirement. That, to me, is very, very important. We want to make sure the first segment, we talked a lot about the biggest risk to retirement is in our belief, is longevity. That's a big issue. And I don't think people fully grasp what 25 to 30 years of a portfolio of not having income coming in and drawing down on assets, even if it's just a little, but drawing down on assets and going through probably in 30 years, 10, 7, 8, 9, 10 major bear markets. That's just what statistically it states. In this world, it seems to be happening much more frequently. Knowing that inflation is high, inflation may stay high for years, so we have to worry about purchasing power, future purchasing power, certainly. And then we have to worry about, healthcare costs. It's Fidelity, I believe, and I think I've seen other studies out there, but, you could expect to spend between $400,000 and $600,000 just in healthcare costs. That's an awful lot. Always seems like there's not a chance. I mean, when I read that study, I'm like, this is crazy. No way. It's not going to happen to me. But you look at the power of the research that they have, and that's the number that they're going with. And there has to be some truth to that. So we want to make sure that your portfolio can withstand all of that. And what I do know is if we're in a volatile market and if we see ups and downs, a buy and hold strategy, or a balanced strategy, as they call it, is just not going to be enough. So 630-492-1912. 630-492-1912 to talk with Paige. Paige will set a time for us to talk this week, and we'll have that introductory call and see where it leads us. So a couple things I want to get to before the end of the show. I want to definitely touch on the economic outlook and kind of our beliefs and our thoughts, and really just give you an idea there. I think consumers are spending down their savings and running up credit card balances at record pace. I think you probably have seen that. Could be at a time when corporate layoffs have begun, and in some sectors we're starting to see that. So even as service sectors remain strong, manufacturing new order rates continue to decline. Generally, what that does suggest is weaker demand for goods. That could be a challenge, and that could be an indicator of some tough times to come. And again, I think I think when you see a market drop 30 or 40%, clients are scared of that. That's generally an easy market to weather because it happens so fast, and generally it comes back so fast. The challenge is a no growth or low growth environment. And what does that do to your portfolio or subsequent down years? Look at 2000, 2001, and 2. Markets were down, plus or minus here, but 10, 2001 was, I think it was in the 13% range. And then 2002 was, I believe, close to 20%. That does a lot of destruction to portfolios. And if you don't have a high margin of safety inside of your portfolio, it just becomes an issue. And so, I just want to make sure that when you look at your portfolio, that if we have those times, that you can still win. Because if you can win then you can really, really win when the markets just rip and roar, which I love because it's great and there's so much opportunity to be had. But we have to look at reality here. And corporate profits remain very vulnerable. And when you look at the consensus estimates for the S&P 500 earnings this year is higher than it's right around $224 a share. And, that forecast is an issue. And if you look at for the last 10 quarters, the nominal GDP has run between 9 and 14% versus the long run trend of 4 to 5%. And the S&P 500 operating margins have averaged, I've read anywhere from 13 to 16.5, 17% versus the 25-year average of 12.5%. So any way you look at it, there is an air pocket potentially, unless everything is just perfect and inflation comes down to 2%. I just don't see it. And I don't know if you see it, but I don't see it. And I look at the data as much as anybody. So the tendency for performance to revert to a long-term average, it could bring about a negative year-over-year change in earnings growth known as a profits recession. And it's anybody's guess what that does to the markets. And that's one thing we can't control. Advisors in this business, there's two types generally. Ones that love the market no matter what. I don't care. Markets should drop 40%. That's fine. Put your money in. You're going to be fine 10 years from now. I mean, those types, right, that just have never seen a bad market. They never think they have to play defense. And it's just buy and hold all the time. And my question is, well, if that's what you want, why are you paying an advisor for that? Because I thought an advisor was supposed to be there to help you navigate choppy waters and choppy seas. But most don't. Most just get paid to tell you to sit and wait. And, ultimately that's an issue. Then you got the advisors that just can't stand the world. Everything's bad. No matter what, it's been negative. Markets, it's just negative. And let's put your money in gold, silvers, precious metals. Let's buy, CDs, something that's going to earn 1 or 2 or 3%. That might make you feel good, but then we're just shifting the risk to longevity. So, I mean, it's, the key is just have a good portfolio that can hopefully do well in all markets, because there is strength in the labor market. That is persistent. And there's certainly been headlines on layoffs. We've all seen them, many in the tech space, but the U.S. labor market has remained strong overall. If you look at, and that generally they measure that by large numbers of new job openings and a recent 53-year low in the unemployment rate. So you would think that's great news. A resilient job market could certainly help the economy achieve a soft landing. Robust real wages support consumption, but the conundrum is the Fed wants to see real wages go down. And when real wages aren't going down, that means inflation is probably staying where it's at, going up, or certainly not going down as quick as they want it. So these are challenging times, and I love challenging times because there's so much money to be made in challenging times. You just don't know it during the time, but you have to have the right portfolio. You have to have the right construction. You can't work with an advisor that just lets your money go down and you don't have cash to put to work at lower prices. So it's ultimately going to be better shortly down the road. The balanced strategies, the set it and forget it's, the that type of stuff, it's so self-serving because they're still getting paid, right? And the job is easy. If I only had to say, don't worry, you're going to be fine. I mean, is that worth the 1%, 2% that people are paying? I mean, so, more than anything, please take away from this week that when you look at portfolio construction, protected growth, protected income, we want that bucket covered. The rates today are off the charts. If you're content with 100% principal protection, your gains locked in every year, never to go down in future down markets, and currently, now that's currently, it could change tomorrow, but currently you get the first 15% of the S&P 500, well, that's a great strategy. If you want a strategy that you can leverage the balance sheet for distribution yields that can pay you a paycheck much more than what you could go and do on your own, we can do that as well. That's our protected bucket. Pros and cons to everything, of course, but that's our protected bucket. Our growth bucket, if you have mutual funds or index funds, and you have over $100,000, we need to talk. Not transparent, not customizable, not tax efficient. We can do better if you have over $100,000. We have to have a talk about owning individual stocks, owning models that we have access to, that we bring to the table, that you can't generally get on your own, that rank very, very high historically against all managers. Currently, all 5 are in the top 5%, 2 in the top 1, the rest in the top 5% of Morningstar managers that are tracked. So very, very good. And then the opportunistic bucket, that just is what it is. If we're in a flat to sideways market, there's going to be some money to be made because we're seeing big dips in certain stocks that are very good. And you can buy things that are on sale and they're going to go back up. And then once they're fully appreciated and they're at fair value again, you rinse and repeat and try to find another one. And with technology and following the money flows, that is available to be done today. So that's it for the week. I hope everybody has a great week. Make it a profitable week. Anything that I said that you want to have a conversation about, just give us a call. Reach out to Paige, 630-492-1912, 630-492-1912. I hope everybody has a safe and happy week. I look forward to being back here next week to share my education, my wisdom, or I hope I have some wisdom, and allow you to decide what you want to do with it.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.